Welcome everyone to another episode of Mere Finance. Today we are going to talk about something unusual that is going on in the market. So the reverse repo, is it signaling trouble? Let's see, let's find out. But don't forget to subscribe first. So you can see the 1 month is practically yielding 80 bips below the effective Fed funds rates as of yesterday. You can see this from Treasury Direct, 4.08 was the yield to maturity for the 1 month. So the effective federal fund rates is at 4.83 and the 1 month Treasury sits around 4.808, so 80 bips. And why? Well, we think there is a reverse repo issue. So those that don't have access to the reverse repo purchasing facility are stuck with Treasury bills. Basically every organization that is not a bank, so pension funds, asset managers, endowments, is where they park their short-term capital. So the Treasury right now cannot issue as much bills due to the debt ceiling agreement, which still has to pass in Congress. So there is a high demand and a low supply for bills right now, which, as we know, as prices go up, yields go down. But what is the reverse repo? So it's a mean to keep the federal fund rates in the target range. So it's the money in the financial system that is parked, that is not being used. So the Fed desk sells securities to a counterparty, which is the banks, subject to an agreement to repurchase the security at a later date. But this depends highly on the government and the Fed Reserve being able to sell those again. So reverse repo transactions temporarily reduce the supply of reverse balances in the banking system. It's basically banks putting money into the big bank, which is the Fed Reserve. You can see that it has been highly elevated since May 2021. Now it says like around 2 trillion. Why? Because as the Fed balance sheet starts reducing, then the way to do this is to have more money in the reverse repo. So all the money that is in the market now is being parked at the Fed, which shows clearly a reduction of the balance sheet. But it's also not reducing because of the high rates in the money markets. So especially in the front end of the curve, when you can, from 1 month, you can have 4%, for the 6 months, 5%, then banks prefer to put that money there in the Treasury bill instead of just lending it. So there's a huge pressure between the reverse repo coming from the high yields in the money markets. So trouble, I think there is trouble because something big is going on behind the scenes. So the best collateral of all, which is the 1 month Treasury, is getting incredible bids again today. So it's probably a collateral squeeze. To move the Treasury market with this volatility, big players have to be in charge of making those bids. So it is possible to earn 4.8 via reverse repo with the Fed, which is overnight and fully collateralized. So why will you be like crazy on the 1 month bills yielding 90%, 90 bips or 80 bips less? Well, the only reason is because you are desperate for the best collateral, which is the 1 month. So definitely a risk off symptom that the market, the banks see some trouble in the future, and instead of parking the money in reverse repo, they prefer to go a little lower, but with safer measures in the 1 month Treasury bill. So let's see next week. Next week is going to be big for the equity markets. All conditions are given for a risk-off event, but as we know, markets are unpredictable, so we'll see. Thank you for listening, and don't forget to subscribe.